The port of Corpus Christi was still. No tankers on the horizon. No engines echoing across the water. No contracts being signed. By the middle of 2025, U.S. oil shipments to China hadn't declined. They had vanished, collapsing from 160,000 barrels a day to almost nothing. No official ban. No fiery press conference. Just a quiet 10% tariff, and the sound of the United States' biggest export dream dissolving into silence. While Trump stood at a podium claiming victory, declaring energy dominance complete, Beijing simply stopped picking up the phone. The ports America spent a decade expanding to feed China's hunger for crude now sat underused, half idle, their pipelines running thin, their storage tanks full not from booming production but from global indifference. And this wasn't noise. It was a signal. In Washington, Trump raged about wind turbines and birds, oblivious to the real energy shift playing out in contracts and currencies oceans away. By April, China had secured long-term oil deals with Russia, Iran, the UAE, and Saudi Arabia. Bloomberg confirmed most were settled in yuan. Not a single one touched the U.S. financial system. This wasn't diversification, it was deletion. China was extracting American oil from its future with surgical precision. And the painful irony? The infrastructure that now sat empty was built by America, for China. Between 2015 and 2023, more than $25 billion had been poured into Gulf Coast ports. New docks, deeper harbors, massive terminals built to handle Asian-bound supertankers. The logic was simple. Dominate the fastest-growing oil market in the world. But by 2025, that bet had collapsed under its own weight. Chinese refiners didn't wait for tariffs to be lifted or trade policy to stabilize. They just walked. Even when American crude was discounted, it was ignored. Reuters reported in May that U.S. barrels were passed over entirely, not because of price, because China had already moved on. Its refineries retooled for Russian and Middle Eastern blends, its payments flowing through yuan, its ships tied to ports beyond Washington's reach. And how did the White House respond? By blaming Canada for lumber, by threatening tariffs on Mexico, by pretending the vanishing oil trade was irrelevant. But this wasn't an oversight. It was policy failure wrapped in denial. Trump's administration had built the most ambitious export infrastructure in U.S. history on the assumption that China would always be there. And when it wasn't, there was no backup plan. The result? Abandonment on an industrial scale. By June, Gulf Coast tank farms were running at less than 60% capacity. Corpus Christi, built to move 3 million barrels a day, was pushing out less than a third of that. That's not a slowdown. That's collapse. Still, Trump's team spun it as strength, proof that America didn't need China. But the truth was visible in every idling tanker, every unused dock, every silent pipeline. The export strategy was never about global diversity. It was about one buyer. And when that buyer left the table, the whole model fell apart. Even Trump's reversal on aluminum tariffs, sold as a strategic shift, was really just an admission of lost leverage. According to the Financial Times, Canada and Mexico now moved over $120 billion in trade annually through their own cross-ocean corridors, bypassing U.S. territory altogether. Why? Because reliability matters more than rhetoric. And America's version of leverage had become code for risk. But oil is more than just fuel. It's geopolitical muscle, and muscle moves through currency. By mid-2025, Bloomberg reported that over 80% of China's oil imports were no longer priced in dollars. That change rippled far beyond tankers and terminals. Every dollar left out of those deals was one less unit flowing through U.S. financial systems. One less opportunity to track, to pressure, to sanction. Power was bleeding from the system quietly, efficiently. Iran understood. By the second quarter of 2025, Chinese imports of Iranian crude surged to 1.7 million barrels per day, 10 times what the U.S. ever managed. And it didn't move through normal channels. It flowed through a ghost fleet of shadow tankers, vessels flying false flags, owned by shell companies, masked by gray market paperwork. This wasn't just dodging sanctions. It was deleting them from relevance. Despite tighter U.S. enforcement in early 2025, Wall Street Journal analysis showed that nearly 40% of Iranian exports went undetected. And China's independent teapot refiners? They bought it all without flinching. No confrontation, no announcement, just a quiet rewiring of the global oil economy. Away from the U.S., away from the dollar, away from everything Washington thought it controlled. No shots fired. Just spreadsheets. Cheaper. Easier. And above all, not American. Once upon a time, U.S. oil had the trifecta. Competitive pricing, unmatched scale, and a shiny label. Freedom molecules. But the world moved on. Faster than Washington noticed, smarter than Washington expected. Price lost to predictability. Scale lost to sovereignty. And that freedom branding? It collapsed under the weight of its own arrogance. Washington looked east and saw a rogue Iran. What it missed was a realignment. Saudi Arabia, the historic anchor of America's oil diplomacy, was already breaking ranks. Aramco began accepting yuan from Chinese buyers. Not just transactions, investments. Billions poured into Chinese refineries. Not just buyers, partners. Not just exports, entanglements. Locked-in infrastructure. Locked-in futures. Locked out America. By mid-2025, China's strategic petroleum reserve crossed the 3-month mark. Surplus secured. And the suppliers? Russia, Iran, UAE, Saudi Arabia. All outside the dollar, all outside SWIFT. No trace of Washington. It wasn't just a change in vendor. It was a firewall, built intentionally, piece by piece, deal by deal. Not to confront America, but to leave it behind. And the irony. America made this possible. After 2 decades preaching energy security, it weaponized its own system. Until nobody wanted to touch it. What followed wasn't rebellion. It was escape. Quiet, calculated, permanent. While U.S. officials paraded trade wins, the core of global oil trade, the dollar, was eroding silently. India joined next. Deals routed through rupee-yuan corridors. Western banks cut out. Iran and Russia now moved crude without ever touching a U.S. server. Even Europe, still dependent on some U.S. supply, was rewriting terms. Longer payments, alternate currencies, insulation from dollar volatility. These weren't tweaks. They were exits. Not political gestures. Structural pivots. America didn't lose a customer. It lost the last piece of real leverage, control over how oil is priced, paid for, and punished. And it didn't happen through force. It happened through competition. Competition America believed it was immune to. Even Canada turned. America's oldest oil partner. Rerouted flows to Asia. A 40% drop in Canadian crude shipped through U.S. ports. Why? Tariffs. Chaos. Uncertainty. The fallout of trying to renegotiate the world in a single breath. The system broke because the system assumed it was untouchable. And now, the U.S. is left with stranded infrastructure. Ports for buyers that vanished. Pipelines with nowhere to go. Payment systems no one logs into. A strategy that bet on price-beating politics and lost hard. U.S. exporters are now scrambling for scraps. Smaller markets in Europe, South America, Southeast Asia. But they don't match China in size, stability, or speed. You can replace a deal. You can't replace a system. And by Q3 2025, the system had moved on. What remains is noise, grandstanding speeches, infrastructure no one wants, a political class still blaming windmills while the world cuts deals without us. America helped build the global energy order, and is now being written out of it. Not banned, just excluded, not punished, forgotten. This isn't isolation. It's irrelevance, and irrelevance doesn't knock. It seeps in. One unsigned renewal, one rerouted tanker, one UN-cleared shipment, one missed call. This shift wasn't about confrontation. It was math, cold geopolitical arithmetic. And when the world sat down to calculate, America wasn't in the room. Then came August. China's customs agency confirmed what many suspected. Not a single U.S. oil tanker cleared Chinese ports that month. Zero. No crude, no processing, no delay, just absence. S&P Global reported even backup orders had evaporated. American oil wasn't just undesirable. It had become unworkable. Simultaneously, China's state-run Bank of Communications launched a new settlement protocol. Direct yuan payments between importers and suppliers. No SWIFT, no dollars. No detours through Western oversight. Pilot programs were already live between Chinese banks and counterparts in the UAE and Iran. Not tests. Not trials. New infrastructure already online. Saudi Aramco, once the crown jewel of the petrodollar, signed a joint venture in July to build yuan clearinghouses inside the Shanghai Free Trade Zone. Not ports. Not tankers. Clearinghouses. China isn't just buying oil. It's institutionalizing its own currency as the new global settlement layer. This isn't a currency war. It's a currency migration. Slowly, systemically, transaction by transaction, America is being replaced. And Washington's still threatening sanctions for a game that fewer and fewer nations are even playing. The market didn't abandon America. It outgrew it. It adapted. It evolved. So the question isn't, how did we lose China? The question is, what happens when the rest of the world realizes they don't need us either? Because when the world stops calling, it's not leverage. It's not a phase. It's the future. And America isn't in it.